Welcome back, traders, to another video. In today's video, we're going to cover the best Forex strategy in 2020. Now, if you guys are new to this channel, I highly recommend you go back to earlier videos so that way you can kind of watch earlier videos and understand what this channel is about so you guys aren't too confused. But if you're a veteran and you're watching this, welcome back. In today's video, I'm going to be sharing the smart money concepts that I've been talking about for weeks and weeks and weeks now. And a lot of people think that whatever your Forex strategy is, it needs to be this, and this. It needs to have a trend line, it needs to have Fibonacci, whatever. But in today's video, I'm going to be sharing with you guys exactly how these Forex markets work and exactly how to understand what is going on behind the scenes. Now, I'm just going to jump right into it because this may be a little bit of a long video. I'm not too sure at this point. But the first few things I want you guys to understand is that no matter what Forex strategy you work, none of it will work without two things. You need to first have a trading plan and rules and have a strong mental game. So basically your mental analysis on the charts. People think technical analysis is the most important. Your mental analysis is the most important part of your trading, because if you can't get your mental game strong, then you're going to be weak on these charts, and so is your bank account and your trading account. Number two, the second thing that you guys need to really understand while trading is that risk management is the second most important thing. If you can't manage your risk, if you can't manage your capital, it does not matter if you have a $100 account or a $10 million account, because if you're risking too much per trade, if you're losing too much, then it really doesn't matter. But that's something that a lot of people don't understand, and that's just how a lot of traders fade out over the years, and they can't turn this into a profitable income. So those are the two things we need to understand before we actually get onto these charts. Now, I want you guys to understand, really ask yourselves, how do you think that the Forex markets work? Because I'm going to come over here onto Wikipedia real quick, and I want you guys to understand that the Forex market is a multiple trillion-dollar market. It is a 6.6, give or take, trillion-dollar market, which means there's $6.6 trillion per day being moved in this market. Really ask yourself, if you really think that much money is just in the Forex world and is for anybody's to take, you need to think again. Because when there's a lot of money involved in something, especially investing or day trading, there's going to be manipulation. There's going to be corruption. That's what a lot of traders struggle with, is they think that you come into Forex trading and if you just learn the right strategy, you can become a millionaire. No, you need to understand that there's people in these markets. There are things in these markets that are controlling where the market moves. That's why 95% of traders lose, is because they're all trading the same way. They're all trading with their support and resistance. They're all trading with their trend lines, their indicators, and these big players understand that, and they are manipulating the markets in order to hit your stop losses, take you out of the market, take your money, and make themselves richer. So just remember, this is a multiple trillion dollar a day market, which means there are people who are manipulating this market. And if you come down here, you can see the top 10 currency traders in the world are all what? They're all banks. Banks, hedge funds, whatever. These are the big players. These are the people who are controlling this $1 trillion a day market. These are the people who are moving the market in whatever direction that they want to. So now, let's go back onto the charts. Remember that if banks are controlling this market, and if the only way that they can take or make money is by taking it from other people, and 95% of traders are losing, how do you think that they're making their money? Well, in order for the bank to make money, they need to hit the stop losses of retail traders. Hence, why retail traders are losing 95% of the time, because they are trading in a retail way. They're trading with these types of patterns. right? You can come on Google or babypips.com or wherever, and you can study and memorize all of these Forex patterns, all of these candlestick patterns. And do you really think that it's just this easy? These head and shoulders, these double tops, these pennants, these are things that are created by the banks. These are formations that are created by them in order for retail traders to use because they know they've memorized it, and then they take advantage of it. So I'm going to show you guys a couple examples of this. I'm not going to go into everything just because I don't want this video to be like 4 hours, but I just want to show you the concept of what I'm talking about. And this isn't really a strategy. It's more of a thought process. It's a new paradigm of thinking in your markets. Instead of thinking that there's a strategy that's going to make you rich, think like a bank would. If you're a bank and you only make money by taking it from retail traders, how would you make your money? Obviously, you have to hit stop losses. So let's go into a couple examples of what I mean. So the first example, this is a pretty good one. I'm just going to mark this area up and hop onto smaller time frames for you guys, just so that way you can see what I'm saying. So we're going to mark this area up, hop down to a 1 hour. All right, so let's walk through this process. Let's think like a bank. Instead of a retail trader looking for double bottoms and double tops, head and shoulders, whatever, let's think like a bank for a minute. So when we are coming down into these markets, we need to understand that in the Forex market, the market has to move in kind of like a nice wave up and down, sellers and buyers back and forth, right? Because when you see something like this in the market, when you see huge moves, huge spikes, I think every trader knows, even if you've never traded or invested before, that just sticks out. Something like this sticks out like a sore thumb, because when you see price action coming up and down, back and forth, that means there's buyers and sellers in the market, which is good. But when you see massive spikes, whether it's news or whatever it may be, just realize this is manipulation done by these 10 traders or other banks that are participating. Because when there's enough money on one side of the market will move. That's why if the market goes down, that means there are sellers in the market. The market goes up, vice versa. But if it moves super quick, it's because there's so much more money forcing the market to come down. And if a bank is owning, let's say, 12% of the market, and it's a $6.6 trillion a day market, they're flooding the market with a sell position, which is forcing the market down. All right, so obviously, as a retail trader, we understand that the market needs to move like this. And when we see patterns like this, what's the first thing that you think of? If you're a retail trader and you see price, it's just kind of stalling and stopping at a certain point, the first thing that you're probably going to mark up is, one, this is a good support area. This is a good floor, right? Price has come down multiple times and tested it, right? We've got that one touch, that two touch, that's a double bottom. We've got a triple bottom. So that means if price comes back down to this area and gives us some type of a candlestick pattern or whatever it may be, we're going to buy. Because if you would have bought here, you would have made money. If you would have bought here, you would have made money. If you would have bought here, you would have made money. So the same is true if it comes down for a fourth time. And so what a lot of retail traders are doing is that they're setting their support over in this area and they're looking out into the future, because when price gets down to this area, whenever price starts to show us dojis or engulfing patterns or things like this, then as a trader, when you see this being played out live, right? When you don't know what's going to happen next, the first thing that you're doing is, one, you're identifying that this is a strong a floor or support, and price typically repeats itself, which means if it comes onto this area, it's risen, it's rejected it. So why can't it happen again? If price repeats itself, it's going to do the same thing over and over again. So what we're going to do as retail traders is we're going to set up our buy position, right? Because we already missed this move 3 times. We don't want to miss it a 4th. So what we're going to do is we're going to buy in this area. Our stop loss is obviously beneath the low, right? We're going to give ourselves a little bit of a breathing room. And our target is above the highs, whether it's here or here. Let's just say it's here for now. You look at that risk to reward, 2.71 to 1. You're balling. Good risk to reward ratio. Price has rejected this area multiple times. If you look to your left, it used to be a ceiling or a resistance. So this is looking like a really good setup. Obviously, our risk is right there, that red line. And what happens is price will dip right beneath your risk, right beneath your support, and just take off. And as we can see, price just flies away. Now, I'm going to walk you guys through why this happens, because you can go on any chart, and I'll show you a couple more examples on different pairs, and then I'll talk you through. Remember, as a bank, in order for you to make money, you have to hit stop losses. So if you know that 95% of retail traders are trading in a retail way, they are seeing these types of patterns, whether it's a double bottom or a triple bottom or support or resistance or head and shoulders or pennants or whatever it may be. Whatever these retail traders are seeing, they're understanding that when the market is in this area, it has rejected multiple times, and in those times, price has flown up from this area. And so if price repeats itself or history repeats itself, it's going to happen again. And so what we're doing is we are buying in this area, right? Retail buys are in this area, which means retail stops are below the lows, or they're 30 pips under, or they're 20 pips under, or whatever it may be, whatever rules that retail traders decide to use. Just realize that 90 to 95% of stop losses are right there. And so what big money does, because remember, if there is enough sellers or there's enough money going in the sell position, the market will move down. And so what banks will do is they will flood the market with sells until they grab most of these stop losses from these buyers. They will hit their stop losses and then buy the market. Because remember, on the other side of your trades, if you are selling, then someone else needs to be buying. That someone else can either be another trader, a hedge fund, a bank, or your broker. And so there's always someone else against your trades. If that person is a bank, which it mostly is, that bank is going to want to make money because they can care less if you make money or not. They want to make money. They're the greedy ones. They're the people who are manipulating these markets. So if most of these stop losses are under here, what do you think is happening? They're pushing the market down, hitting these stop losses, cashing in right here, and then buying the market back up. Because once they've eliminated all of these buyers, because remember, not everyone can make money. If everyone's buying, then there needs to be a seller. Who are those sellers? It's the banks. If the market's going up and the banks are selling, that means they're losing money, which is no bueno for them. So what they need to do is eliminate all buyers if the banks are trying to get into a buy position. So if they know all the buyers' stop losses are usually beneath the lows, because that's what retail traders typically learn, they need to take them out. So what they do, they manipulate this, they push the market down, hit those stop losses. Then this is the point where all of those big money players get into the market. This is where all their buy positions are. Their buy positions are where retail stop losses are. And then that's why you see this super fast move, because now there are no more buyers in this market except for the banks, and the market just flies. Now, if you guys don't believe me, I'm going to show you a couple more examples of this. We can go to any chart. I'll go to GBP, JPY. We're going to do the same thing. We are looking for sells or buys in this particular instance. Or actually, okay, so now we're on GBP, JPY, and in here, we can see the market. Now, remember this, if you're not seeing anything, it's always good to look at the bigger picture. Always go on higher time frames, because if you're stuck looking at one time frame, you're going to miss the bigger picture. So one that I have here is an extremely good selling opportunity, and I'll just show you guys on this 1 hour time frame. So what we see here is a lot of consolidation, right? It's just the market's kind of chopping back and forth, back and forth. You could have made money in this, you could not have, but usually in these types of markets, you want to stay out because the market is not trending. But I bet you a lot of people lost money when they were looking to sell this market. Now, what I mean by that is when you look at the market, it's trending up and up and up and up and up, and then it finally just hits this ceiling, right? This massive ceiling. And then what does market do again? It drops off. Traders see this one more time, huge wick, it drops off. So now traders are looking at this and they're like, ooh, this is a juicy sell area. Because look, market came up once and it dipped. Market came up twice and it dipped. A third time and it dipped. And so a lot of retail traders are seeing this type of thing and they're like, next time the market gets in this point, I'm looking to sell. And again, let's just remember what all those traders do, right? We look at this market. If the market gets back in this gray area, typically you're going to want to sell, because what happens? History typically repeats itself. So when the market comes up here, it drops. Comes up here and it drops. So the next time it comes up here, I'm looking for a sell. My stop loss is above the high because I want to try to get the best risk to reward on this trade. So my stop loss is right above that high, or right above these highs. These are the retail stop losses, this red area, these two red lines. So what happens is you're a retail trader, you're looking for those sells, you're looking, right? You're waiting patiently, you're waiting days, maybe even weeks for this setup to go. And then finally, the market looks like it's starting to trend up to your spot. It's starting to trend and trend. And then finally, market gets up to this point. What we're going to do is we're going to put in our sell position, because that's what we've been waiting for so long. When it gets to this area, obviously our stop loss is always above the high, right? Because the market can't go any higher if it's going to drop. And then our rewards all the way down here, right? We got our 7-to-1 risk to reward ratio, and our stop loss is above, around in this area. And so what happens? Market comes up, hits those stop losses. On a 4 hour time frame, it might be a little more visible. What happens is your stop losses are above these highs. The market comes up, stops a little bit. Now you've got either sell limits or people selling just in real time. So you got sells, 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 and your stop losses are right around this area, right? So this gray area is going to be your sell zone, because in the past, that's where it sold off. So market gets into here. Now you've got sellers, 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 sell limits, market execution, whatever it may be, and your stop losses are right here. And so what happens is the market shoots all the way up. Then what happens next is there's just an impulsive move, a huge wick, right? A huge wick up to those stop losses, and look where it stops. Perfectly above this high. Because above the high is usually what? Stop losses. So big banks take all the sellers out of the market. There are no longer any retail sellers. And then what happens is this is where big banks and big players are selling. These are their sell positions. Their sell positions are at your stop loss. And what happens immediately after, since there are no more sellers but the big banks, they send the market crashing down. And again, this happens over and over and over and over again. And you can see even here, right? Just think like this. You're a bank. When you see retail patterns like double bottoms, triple bottoms, whatever, you have this pattern, right? You've got, let's even move it back a little more. You've got, we don't even have to call this touch, but let's say we've got our double bottom, our W, whatever. You've got one rejection, a second rejection, and a third time the price is going to get over here It has to happen because history repeats itself, right? So it has to happen. And it usually does. Retail traders are usually correct. The thing they're not correct about is where they're putting their positions in, where they're buying or selling. Usually they are buying or selling in this gray area because they don't want to miss the move, right? They don't want to put a buy limit or execute their buy too low, or else they'll miss the entire trend. So what they do is they buy in this gray area. And what they do is they put their stop loss beneath the low. And what happens, just like clockwork, you see the double bottom. Most retail traders see it as well because this is created on purpose. Your stop loss is beneath the low. Market goes down, 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 just enough to wick you out right on a Friday. Market closes, and then it ends up back here and it shoots up. So sure, all the retail buyers were correct, but most of them got stopped out because their stop loss was somewhere beneath this low or right here. And what happens is they get stopped out, and then the market moves in that direction. So think to yourself, has this ever happened to you? Have you ever been in a trade where you predicted that the market was going to fall or rise or whatever, and you were correct on your analysis, but you got stopped out before the actual move happened? And I'll give you guys one more example because I don't want this to be an extremely long video. But let's take this. Let's say you're a trend line trader and you're seeing this beautiful trend right here, and you've connected your points. Boom. So what we have here is we have our origin, right? This is where the trend line starts. We've got our second touch, which respects beautifully. And then obviously our third touch is where we're going to sell. So obviously people are making money from this because if you saw this, you would have sold here and you would have made a lot of money. But there are some people who didn't see this, and so they are also selling because they don't want to be left out in this market. And what happens is when it gets back to this price, right, this trend line, people are seeing these dojis, these wicks to the top, and so they're putting in their sell positions. And like always, where do you think those stop losses are? Just above the trend line, just above this high, just above this high, right? Maybe it's 30 pips, maybe it's 40 pips above this trend line, whatever it may be. Just realize this trend line is so obvious. Do you really think that the big banks don't see that, or they didn't create it? They're very aware that there are a lot of retail sellers in this point because of this very obvious trend line. And so what happens is when you get enough sellers, the banks get to notice that and they know where your stop loss is. And so what they do is they push the market towards those stop losses. They take out all the sellers and then absolutely reverse the market. So that is basically just kind of a very small, very little crash course on kind of how these markets work. If you've never seen this before, I've never thought of it that way. Definitely some food for thought for you guys to really go back and back test this type of stuff. I would highly recommend that you do back test this because this may seem a little crazy, but like I said before, just remember who the actual people are that are controlling this market. They're controlling over 50% of this market. So if you think that they're not taking advantage of these retail patterns, these retail traders and these retail stop losses, then you need to think again, because moves like this in the market are not just random. They're not just news events. Remember, news is an excuse to move the market in a certain direction very rapidly. And there's a reason why this type of stuff is quick, because typically traders can't respond because they don't know what's going on. They're losing all their money, so they're acting out of fear, which again, if you're mentally weak in this, you won't make money because you won't know how to react to this type of stuff. So again, in my opinion, this is the best way to look at the Forex markets. And like I said, it's not a strategy. It's just a new way of thinking, a new way of looking at these markets. Think like a bank. Think like smart money. When you think like that way, then you'll understand why these crazy types of moves happen, why you keep getting taken out of trades, even though your directional bias was right. And when you think like this, when you understand that the markets are manipulated, then you will start to see better results in these Forex markets. So I'll keep making videos like this just so I can show you guys more examples and hopefully explain it in different ways in different videos, so that way it could start clicking for more people. But like I said, continue to watch these videos. If it's helping you, that's super awesome. Leave it in the comments. I'd love to know if this is helping anyone, and we'll just continue to make videos. So we'll see you guys in the next one.